Today, I'm very excited to be joined by Frank Williamson, the founder and CEO of Oaklyn Consulting. Frank, thank you very much for your time today. It's a pleasure to have you on. Could you start by telling us a bit about your background and telling us about Oaklyn Consulting?
Of course. Amaan, thanks so much for having me too. You've got a good series here with this podcast. As background, so I've been running Oaklyn Consulting about a decade. And before that, I had done two things that are relevant. One was run a normal lower middle market boutique, and the other was spend the first part of my career in big company, Fortune 500, investment banking, and then management work. And Oaklyn Consulting is a little bit of a merger of those two ideas.
Thanks for that background. Tell us a bit about what that merger of ideas is about.
So, so when I took over as in the managing partner role of a little boutique after the credit crisis that needed to grow again, one of the things I had thought that I think many people in the deal business think is that deal advice is really not that different between big deals and small deals. It's a lot of the same work either way, and that's true. But there is a difference that I didn't appreciate, which is that the sort of the level of forgiveness in the economic model is really quite different. So, for example, when I was the person being covered by the bulge bracket banks at the insurance company of where I worked before that, we would work on deals and have, say, JP Morgan advise us on them. We may or may not decide to close that deal, may or may not put in the winning bid. We certainly would ask the bankers for lots of work. Now, if we didn't close the deal, they wouldn't get paid the transaction fee. But as a financial institution, we were probably doing 10 things with JP Morgan at any point in time. And worst of all, we could say, look, we appreciate your work on this. We can't pay you on this deal, but we'll give you lead left on the next bond offering. But there's sort of everyone is invested in the ongoing relationship and it being a healthy business relationship. Move to the world of small to mid-sized business M&A advice, often at the point of it being the end of the business owner's career. And if you move along, do the work, and for some reason the deal doesn't close, let's put aside reasons where the deal might not close because the investment banker did a bad job. But the investment banker does a good job, the deal doesn't close, it doesn't close on time, there's no fee, just like in big deals. But there's also no other business with that business owner, right? So it's a one-time relationship that's going to result in a one-time fee, not an ongoing way to do business again. So there's no way to get somebody, to get somebody's back for having done a good work, but things not working out. What that causes is that small company investment banking is just, it's one of two things. It's either just much more transactional, right? You only work for the people who close, and you only take on assignments that will close within the normal expected amount of work, right? Just a very transactional approach to the work. Or you very carefully only work for people who actually can give you multiple assignments. And so and I know as you in your business do lead gen for investment banking boutiques, you see many boutiques that strive to be standalone financial sponsor groups. Well, you'd love to, financial sponsors are rigorous clients, but they also do lots of deals. And so if you're doing a great job, something happens with one deal, there is another piece of business out of that same relationship to do. And what we learned was that what that does is it leaves a lot of people who could really benefit from the investment banking expertise and service just unserved because their situation is not in any ways a bad company. It's just not a clean enough deal to make economic sense to a busy professional banker when they have other choices of who they can work with. And so we said, look, there's a market need. Let's see if we can get paid for serving that market need. And let's take the approach that says we will work on things that are just bad engagements, right? They're unlikely to close or unlikely to generate a large enough fee if they do, or unlikely to get done in the normal amount of work. But if we can be paid as we go, we don't care so much about that. So there's fair compensation for services as we move along. And that was our way of trying to serve an unserved market with respect to business owners. And I think just as importantly, it was our way to be complementers to, rather than competitors with, our investment banking peers. And in particular, what we wanted to do was to work alongside investment banking departments of larger financial institutions who have a who are operating as part of a bigger institution with cross-selling as one of the goals. So, for example, wealth management plus investment banking in the same institution, or wealth management, commercial lending, and investment banking in the same institution. And we wanted to find a way to help those investment bankers be more successful with their cross-selling efforts. And as you can imagine, there are many, many business owning clients who would be great clients when they get liquidity of a wealth advisor whose deals are just too small or too risky for the investment banking department. And that's in particular what we wanted to do, was help those wealth advisors and investment bankers work better together by enabling the investment banker to say yes to the deals that make sense, and send to us as a way to say yes to the deals that don't make sense to them but are still important to their peers.
Okay, thank you for walking us through that. So typically, a lot of deals are contingent based if the deal closes, but where you operate is the model where you don't operate on that model. It's more just a retainer model, or you get paid regardless of whether the deal closes or
That's
not.
right.
And the benefit is that a lot of times bankers may not want to take on a deal where they have a less likely, where they assume it's a less likelihood to close. So then that's where you can step in. So I see where there's the benefits there. Do you ever get pushback then from owners who are maybe typically used to the model of paying upon completion to now have to essentially pay based on, time spent?
We may, and we may or may not see it. Our goal is to be a solution for someone who needs the service and can't access it another way. And so, what we often do with owners is we recommend to them that they interview us as a service provider, and they interview traditional investment bank, people operating in the traditional model as a service provider, and then they're able to choose. And what I think, if we really are selecting for things that are bad deals from an investment banking perspective, then what people will learn is either they get a very low level of service for the transaction fee, and that doesn't suit them, or there's just no one who will take them on as a client, and that doesn't suit them, right? And our view is, if someone can get service from the normal, from a boutique or a larger investment bank offering the service on the normal model, they should take that. And so we really try to fill a hole in the market rather than just having two billing concepts that compete with one another.
What do you typically see in those companies that end up coming to you where the traditional banks might say there's less likely to get them getting sold? What are some of those patterns in those businesses? What is it that causes that to happen?
There are three things, and the biggest one of them is that the odds of success are not very high, but the business owner needs to go through the work to try to get a deal done. And but the other two things are, the deal is just too small, right? And so if someone applied or in our part of the market, many investment banking departments try to manage to $1 million minimum fee. So at normal investment banking rates in the US, maybe in the UK too, that's about a $50 million enterprise value deal. So three things: low probability of the deal closing, but the business owner still needs to pursue it. Second, just small for the necessary fees. And so if many banks in the US have $1 million minimum fee, that's a $50 million deal. You've got a $20 million enterprise deal, and they still need to, for their own P&L, charge $1 million fee. That's just overly expensive, right? And the investment banker knows that, right? They know that that's not going to be the right fee for the deal, and so therefore they'd rather not take it on. And the third is that there is a deal that you just know ahead of time is going to take 3 times as much time to get done as it normally should. And we're not in the business of help make businesses more saleable. That's a different project. This is to say, look, we're in the middle of a deal. There are lots of decision makers. There are lots of deal-related complexities, and it's just going to be complicated. And it wouldn't be complicated for a $500 million deal, but for the $20 million deal that it is, there are too many moving pieces, and it's going to prevent the banker from pursuing the $500 million deal because all their time's getting sucked up in the low-fee $20 million deal, if that makes sense. And we consider other investment bankers sort of our channel partners, right? We spend a lot of time talking with people about how can we help them use their time as effectively as possible. And how can we, by, through our approach to building and process management, you know, solve their really sales related pain points. We've got an opportunity funnel. Some qualify as good deals, some qualify as bad deals, but they probably have some obligation to their peers or to their referral partners to not just rudely say no. And so we want to make sure that we're tuned to what the banker thinks is a bad deal, not not necessarily a bad company.
Makes sense. So those channel partners, I get why that's a big part of how you have built the business. Is that based on relationships that you've built over your career, or has there been an active effort to kind of grow that partnership channel to really expand the business?
Both. Of course, I grew up in financial institutions, and we as a group have some feel for how do financial institutions work, and how do those business models work, and so we wanted to serve other businesses that are sort of like ours. But also, I mean, that's our methodical approach to sales. We would love for every single investment banking department to be a formal channel partner of ours. And so we methodically try to grow our network. And we're not, I think probably importantly, we're not trying to grow a network on the basis of personal relationships. While we like personal relationships, we're trying to grow it on the basis of solving a business pain point for our peer investment bankers.
Understood. Have you ever, and maybe this is not the right fit for your model, but have you ever explored reaching out and trying to build relate or trying to find sellers directly, or is this a model where actually the channel partnership is always going to be the key way that you're going to focus the business?
That's a great question. And many of our peers, many of your clients reach out to get to know business owners directly. We think about our core stakeholder being other investment bankers. Of course, we ultimately get hired by business owners and we do work for business owners. We strive to do great work for them. And how good we are at serving the business owner, of course, reflects back on our relationship with our channel partners. But we're in business to help our channel partners. We're not doing something that's enormously distinguished. There are lots of good investment bankers serving small to mid-sized businesses. We are just one of the good investment bankers serving small to mid-sized businesses. There's no pixie dust in that. But we're one of fairly few people who says, look, we really want to help other investment bankers, especially in diversified financial institutions, do a great job for business owners.
Understood. With those businesses that you end up working with, are there some differences in, for example, the types of buyers that those businesses attract because they've ended up, in your lap, so to speak, compared to some of the more traditional deals? How does that differ to the typical types of deals that investment bankers deal with in terms of the end buyer?
There is a difference. I mean, I would like to say, hey, there's no difference because we're just here, but because the industry does a good job serving much of the market and only is challenged in a little bit of the market, their mix creates a difference. And so our clients are almost by virtue of our clients being smaller mostly and having some complexity that makes them harder to get closed. So the natural complexities would be, say, a lot of customer concentration or a weak internal succession plan. Very, very normal things for smaller businesses to have, right? Those businesses are best bought by other operating businesses. So our clients are almost totally sold as add-ons to bigger businesses. They're almost never sold directly to investment funds. And so I'd say that's probably the biggest single difference is, we are constantly helping think about what's the business strategy reason that a larger company would buy our clients. And we're almost never thinking about how do we educate the staff of an investment fund, enough about the dynamics of the business and then organize an auction that's, in which multiple investment funds are competing to buy one firm.
Understood. Makes sense. One of my final questions now, what's the state of the market at the moment in terms of the landscape that you play in as of right now? Is there still quite a lot of deal flow at this size, or are things on the uptick and the downtick? It'd be good to get a sense from you what the situation is right now.
Yeah, over like if you look sort of year to year, we just don't see any variability. What we see in this part of the market is so much money available to companies that are running acquisition-driven growth strategies, to platform companies or to high growth companies that are doing both organic and inorganic growth. It is I mean, the whole private equity industry is built in part on the idea that you've got the skill to do acquisitions. Once you've got one company, if you can build it up, you can get a larger multiple from having grown, by acquisition too. That's become a huge industry. So ample money there to grow really fast in the venture world. It helps to be able to acquire chunks of revenue as well as just run effective sales processes. So there's ample money there. And if you look at banking, it's a relatively low risk commercial loan to fund acquisitions, plenty of money there. So we see more than enough money, more than enough interested buyers, and little impact from, say, interest rate volatility in our part of the market. And it feels to me over the course of my whole career like there's just lots more money than there probably was at the time I started my career for these kinds of businesses. And we're fortunate there's not a lot of variability from, from things like oil price shocks.
Understood. Frank, I want to thank you so much for your time and ask you one final question now, actually. Separate to the discussion we've been having, you've obviously started this business around 10 years ago and run it since. What's been some of the learnings that you've taken from these last few years of building and running your own business compared to obviously before when you were working as part of a bigger business?
It is a lovely thing to grow a business with someone else's money. And you're building a business and I'm building a business and all of you and I when we go to bed at night and when we get up in the morning probably think, if something goes wrong, the time and effort and money that I've put into this could just go to zero pretty easily just because we make a mistake. And it would be nice if that cushion were not our own savings, but were someone else's, and we could just move on. It was a question of our bonus at the end of the year. So I'd say maybe that's my number one lesson is you're very, very attentive. Maybe this has been your lesson too, to the blocking and tackling of your business when it is something you have built yourself. And of course, I take that lesson into empathy with our clients too, right? Who most of whom are SMBs, and just to remember how much they personally had on the line for their own success as they built something over the course of their.
I can relate to that as well. I think even yesterday I was trying to sleep and I just couldn't because I had a few things on my mind. I was like, wait, I need to do this, this, this. So I guess that's just part of building and growing a business. Frank, thank you very much for your time. It's been a pleasure talking to you today.
Amaan, likewise. Thank you so much for having me on. Take care.